we wised up over time. We got into better and better companies, and we understood more and more of the bad things that could happen to you and how easy they could creep in.
Charlie Munger and Warren Buffett are two of the most successful investors in history. But how did they achieve such extraordinary success? How did they go from humble beginning to building a $100 million empire in the 1960s and then expanding it to hundreds of billions in the following decades? Today, we will explore the fascinating story of Charlie Munger and Warren Buffett and the lesson we can learn from their journey. Charlie Munger and Warren Buffett were born in the 1930s during the Great Depression. They grew up in different states, but from a young age, they shared the common interest in business and investing. Charlie Munger was born in Omaha, Nebraska in 1924. He was the son of a lawyer and a homemaker. He was an intelligent child who loved reading and learning. He attended the University of Michigan, where he studied mathematics and then served in the U.S. Army Air Corps during World War II. After the World War, he enrolled at Harvard Law School, where he graduated magna cum laude in 1948. Warren Buffett was born in Omaha, Nebraska in 1930. He was the son of a stockbroker and a teacher. He was a prodigy who showed an aptitude for numbers and business. He started his first business at the age of 6, selling chewing gum and magazine door to door. He attended the University of Nebraska, where he graduated a bachelor's degree in business administration in 1950. He then enrolled at Columbia Business School, where he studied under the legendary investor Benjamin Graham, who taught him the principle of value investing. Charlie Munger and Warren Buffett met in 1959 when they were both working as investment professionals in Omaha. They were introduced by a mutual friend who thought they would get along. They hit it off immediately and discovered that they had a lot in common. They both admired Benjamin Graham, and they both had a passion for finding undervalued stock and businesses. They also had a similar sense of humor and a disdain for conventional wisdom. They became friends and started to exchange ideas and share insights. They also began to invest together, forming a partnership that would last for over 6 decades. In the early 1960s, Charlie Munger and Warren Buffett decided to join forces and form a formal partnership. They pulled their capital and their expertise and started to look for opportunities to buy and manage businesses. One of their first acquisitions was a struggling textile company called Berkshire Hathaway, which they bought in 1965. They initially intended to sell the company and use the proceeds to invest in other businesses, but they changed their mind when they realized that the company had a loyal customer base and a strong cash flow. They decided to keep the company and use it as a vehicle to buy and own other businesses. They soon expanded their portfolio to include insurance companies such as GEICO and National Indemnity, which provided them with a steady source of funds to invest in other sectors. They also bought stakes in companies such as American Express, Coca-Cola, and Washington Post, which they held for long-term and reaped huge returns. By the end of the 1960s, Charlie Munger and Warren Buffett had built a $100 million empire, which was an impressive feat at the time. They had also established themselves as savvy and visionary investors who could spot values and potential where others could not. Charlie Munger and Warren Buffett had distinct investing strategies and a unique approach to business, which have contributed to their remarkable success. One of the key principles that guide their decisions and actions is focusing on the intrinsic value of a business rather than its market price. To do this, they look for businesses that have durable competitive advantages, strong management teams, and consistent earnings. They also seek businesses that are undervalued by the market and that offers a margin of safety. Another key principle that guides their investing strategy is investing for long term, not the short term. They do not chase trends or fads or try to time the market. They buy businesses that they understand and believe will grow and prosper over time. They also hold onto their investments for decades and reinvest their profits. While they diversify their portfolio, they limit their investments to a few dozen companies that they know well and they can trust. They invest in a range of industries and sectors but avoid investing in businesses that they do not understand or that they do not have an edge. Munger and Buffett are independent thinkers, not followers. They do not rely on analysts, consultants, or the media for advice or information. They do their research and analysis, form their own opinions and judgments, and ignore the noise and hypes of the market. They stick to their convictions and principles. The duo is opportunistic, not rigid. They are flexible and adaptable, willing to change their minds when new facts or circumstances arises. They also take advantage of market fluctuation and crisis, buying when others are fearful and selling when others are greedy. Finally, they treat their managers and employees as partners, giving them autonomy and responsibility. They do not interfere with their operations or decisions unless they are unethical or illegal. They also share their profits and rewards with them and treat them fairly and respectfully. Charlie Munger and Warren Buffett overcame significant challenges and seized opportunities to succeed in their journey. They tackled inflation in the 1970s by investing in high-quality businesses, countered hostile takeovers in the 1980s by increasing their stakes, adapted to technological disruptions in the 1990s by innovating their businesses, and seized the opportunity during the financial crisis in the 2000s by buying high-quality businesses and assets at bargain prices. Charlie Munger and Warren Buffett had created a legacy and an impact that goes beyond their financial success. They have also inspired and influenced millions of people around the world who admire and respect them for their wisdom and their generosity. They have created a culture and a community for valued investing. which has attracted and nurtured many talented and successful investors, such as Bill Ackman, Seth Klarman, and Monish Pabrai. They have also shared their knowledge and insights with the public through their annual letters, their shareholder meetings, and their interviews and books. Moreover, they have donated and pledged most of their wealth and philanthropy, which has supported and improved many causes and fields such as education, health, environment, and social justice. They have also encouraged and challenged other wealthy individuals and families to join them in giving away their fortunes through initiatives such as the Giving Pledge. In addition, they have advocated and practiced ethical and responsible business practices, which have enhanced and protected the reputation and the value of their businesses and their investments. They have also promoted and supported good governance and corporate citizenship through their policies, their standards, and their actions. Lastly, they have advised and mentored many entrepreneurs and leaders who have sought their guidance and counsels on various issues and challenges. They have also endorsed and invested in many promising and innovative businesses and ventures, such as BYD, Apple, and Snowflake. Overall, their legacy and impact are testament to their vision, their value, and their leadership, and they will continue to inspire and benefit many generations to come. Aspiring investors are advised to read and learn as much as possible from various sources and disciplines, and to develop a multidisciplinary mental framework that can help them understand and evaluate businesses and markets. They should also be patient and disciplined, waiting for the right opportunities to invest in businesses that offer a high quality, long-term, and low-risk return. It is important to remain humble and curious, admitting mistakes and learning from them while seeking feedback and advice from others who are smarter and more experienced in the field. Furthermore, aspiring investors should aim to be ethical and generous, investing in businesses that have a positive impact on society and the environment, and sharing their wealth and knowledge with others who are less fortunate and more deserving than them. Charlie Munger and Warren Buffett are more than just investors. They are also teachers, philanthropists, and role models. They have shown us how to achieve success and happiness, not only in business and investing, but also in life and society. Through their teaching, they have helped us to think critically and creatively, learn continuously and broadly, act rationally and ethically, collaborate and communicate effectively, adapt and innovate, and give and contribute to the society. Additionally, they have shown us how to appreciate and enjoy simple pleasures in life, such as reading, writing, playing, laughing, and loving. Their influence has inspired generations of investors, entrepreneurs, leaders, and citizens to follow their footsteps and apply their principles, resulting in a better world for all. We can all learn from their wisdom and generosity to strive to emulate their values and vision. And that's it for this video. We hope you enjoyed watching it and learned something new. If you did, please give this video a thumbs up and share it with your friends. Also, don't forget to subscribe to our channel and hit the bell icon to get notified for our future videos. We have more amazing videos coming up, so stay tuned. Thank you for watching, and see you next time.